Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, the Cap and Capitalize. And today, we are going to go through 10 personal finance goals to achieve by 40. Now, if you are over 40, that does not mean you just need to shut this episode off and just go and pout in a corner that you've passed that mark. You're still going to get a tremendous amount out of this. Also, if you're like 13 days away from turning 40 and you're like, well, I'm pretty much screwed anyway. Not true. You can take a lot of these principles and reinvest it back into yourself. And when I'm going through these personal financial goals, and I say this on episodes, and I'm going to keep reiterating anytime I'm doing, whether it's 10 tips, 7 tips, 4 tips, whatever the case may be, these are not in chronological order from best to worst or worst to best. So don't think that you have to listen more toward the beginning or listen more toward the end. Just enjoy and become mindlessly more knowledgeable, yet also entertained as we go through these. So the first one that I want to get into is get rid of all bad debts. So the tender age of 40 is a fantastic age to rid yourself of any bad debts that you will have acquired up until this point. So first off, what is considered a bad debt? Because not all debt is bad. So for starters, I look at a percentage in the APR. I don't necessarily look at the actual debt itself. Now, sure, if you're just blowing money out of you-know-where and you're just racking up credit card debt and it's a 27% interest rate, that's bad. That's really, really bad. Don't go there. But when it comes to debts, don't necessarily look at the balance. Look at the interest rate, because the interest rate is the rate of return that you are earning as you're paying down that debt. So I like to take the number 6%. So that percentage is going to be mission critical for you to remember, frankly, for the rest of your life. And you're probably thinking, why? So in the long run, let's think about this. Do I think that you can earn more than 6% in the long run? Possibly, in some cases, probably, depending on who I'm talking to, but I cannot guarantee it. Okay? And if anyone that you have talked to can guarantee a return that is higher than that, they should probably be in jail or kicked in the shins because they're lying to you. There are many investment professionals out there that will try to lure you into saying, hey, we are going to earn you this 6%. We are going to earn you this 7, this 8, whatever the case may be. That is not necessarily true. But what I will say is 6% is a really good benchmark for the long haul. I talk about this in my book a lot throughout my course. I've mentioned this in previous episodes. In the long run, since 1950, there has never been a 15-year period where the stock market has actually lost money. And there's never been a 25-year period where the stock market has done almost 8%, 7.94, but we're going to round up. So for 6%, the reason why I use that number, there's actually a couple reasons. Number one, there was a really good article I read a couple of years back by 3 of my favorite researchers in the industry, Dr. David Blanchett, Michael Finke, and Wade Pfau. Funny enough, those were the first 3 guests on my show. Shout out to the big 3. And they, long story short, because this was a thick research article. The next 50 years, theoretically, will not necessarily do as well as the last 50 years when it comes to rates of return on many asset classes. So they wanted to be a little bit more conservative in that regard. And then also you've got to account for taxes. So that's number 2. But then the third one is actually from the late and great Charlie Munger. So Charlie Munger, for those of you that do not know, Warren Buffett's old business partner, again, he passed away at the end of 2023 at the tender age of 99. And he was, for all practical purposes, one of, if not arguably the main reason Berkshire Hathaway got to where it was today. And I believe he was speaking at his alma mater, Michigan, go Wolverines. And it was interesting because one of the questions that was asked of what is your target rate of return? And a lot of these famous investors and successful mega investors, many of which we've had on our show, they try to earn the 10s, the 11s, the 12s, the 15%. They don't guarantee it, but like that's their internal goal. And so I was kind of shocked when Charlie Munger was saying, my entire life, all he has tried to do was earn net of tax 6%. And then his joke was, I just happened to overshoot it, which is like such an investment flex because the guy was worth a couple $1 billion when he died, which is, I guess, ultimate retirement. But the whole point was you want to aim at a number that is statistically achievable based on the facts that you have at your disposal. So now that we have that number and you understand how valuable 6% is, I want you to list out your debts, assuming you have them, from highest interest rate to lowest interest rate. Again, forget the balance for a second. You can write those down. The interest rate is the most important because what you are going to do, if those interest rates are above and beyond 6%, obviously the higher, the more important, you are going to take any of your extra money. In my book, we call that gap money. If you're in business, obviously we call that profit every single month. So you take whatever is left over, that gap money, and you are just shoveling it into that highest interest rate debt on your personal balance sheet, if you will. And then once that debt is gone, you take whatever you were paying towards that debt plus your profit, snowball it into the next debt, until you get to debts that are at the 6% or below. And once you do that, the next question becomes, okay, now that I've got all of this extra cash and this extra cash flow, what do I do with this if I'm not going to go and pay down these debts that are at 6% or for sure below? That actually is a perfect dovetail into the second personal financial goal that you're going to want to achieve by 40, which is to ramp up your retirement savings. Now, I should have mentioned this earlier, but such is life, so here we are. I'm going to mention it now. If you have a retirement plan and you are not contributing at least up to the match, I don't care what it is, dollar for dollar up to 4%, 50 cents on the dollar up to 3%, whatever that number is, if you are not doing that, you are doing yourself a tremendous disservice and you are leaving free money on the table. Forget about if you're in a high tax bracket or low tax bracket. If you have a dollar for dollar match up to whatever the percentage is, think of it this way. For every dollar that you put in, you are getting 100% rate of return because for every dollar that you are putting in, your employer is giving you another dollar. Now, is 100% more than 6%? Yeah. 100% is more than basically any type of debt interest rate that you're going to have out there. And if you have a debt that has a higher interest rate of 100, I don't know, you're friggin' screwed. But jokes aside, you're going to want to make sure you're putting in at least up to that match. Now, let's think about this for a second. If you've snowballed all of those bad debts to the point where you've got all of this free cash flow and these debts that are at 6% or below, you know, okay, I can probably earn a better return in the long run. Can't guarantee it, but I can probably do so. That's where you're going to want to take that free cash flow. And assuming you don't have any short-term needs that you need to pay this to pay off or save up for, you're going to want to start to increase your retirement contributions and rev that up even more, okay? And as you get closer to the 40 mark, in theory, you're going to be making more money. And so with more money comes an issue in the fact that taxes are going to play a critical role into how you are contributing to your retirement account. So if you are in a lower tax bracket, if you're listening to this and you're in your teens or you just started a career in your 20s and you're not making as much, great. Take that money, pay the taxes today, and let that money grow tax-free by contributing to either your Roth retirement plan, if you have Roth option through your retirement plan through your company, or you could open up a Roth IRA and contribute the maximum of $7,000 in that regard. You're going to want to make sure, as a quick caveat, that until you max out your company's retirement plan, you're not going to want to do an individual retirement account or a Roth IRA. And there's a couple reasons why. Number one, cost. A lot of these businesses that offer retirement plans, they provide wholesale pricing. So think of like going to Costco and buying in bulk for retirement versus going to I don't know, Walmart or locally for us, Fred Meyer, Safeway, whatever your mini mart is, to pick up one or two extra things. That's like the Roth or the individual retirement account. It's a more custom order, but it will be more expensive. So you want to max out your retirement plan before you do any of the individual options. But if you are making a ton of money, that means you're going to be paying more in taxes. And so that's where you're going to want to utilize the 401k pre-tax and avoid all of that tax, because the greatest investment is the taxes you avoid. And then if you do decide to go through an individual retirement account and or a Roth IRA, if you're making too much money, you can't put money into a Roth IRA, but you could take money and put it into an individual retirement account. The next day, convert that into a Roth IRA. We call that backdoor Roth IRA, and go that route. But the whole purpose is you want to ramp up your retirement saving as much as possible. So by the time you get to 40, not only have you saved up a really good chunk of cash within your retirement accounts, you're also saving just a ridiculous amount every single year, because compounding, it is an amazing wonder of this world that you do not want to miss out on. So the third personal financial goal that you're going to want to achieve by 40 is to make sure you have a proper emergency fund all squared away. So this one is pretty cut and dry. The range of emergency fund, if you're capitalizing on your savings, we talk about this a lot, is 3 to 6 months. So let's just say that you are on the younger side, you are single, you have a pretty low risk job where you're probably not going to get hurt, job security is pretty stable, and your life situation is pretty simplistic. You could get away with having 3 months of emergency fund, and I don't really think you would need anything above and beyond that. Maybe if you're a little bit anxious, you get up to 4, but anything above, you could probably get away with less on that regard. Let's say on the flip side, you were the only one working, and I'll use myself as an example. Let's say that I was a construction worker, and my wife and my sweet baby girl at home, obviously we're not contributing. And if I slipped and hurt my back and it was out for months and not being able to work, that's where I would probably lean into the 6-month side of things. Now, the only other icing on that cake is, where do you put your savings? People are probably like, what in the heck is he talking about? You put it in a savings account. Sure, but one thing that we've talked about a lot on this show is utilizing online savings accounts. Now, I'm not going to give any recommendations to specific banks for a number of different reasons, but as long as you look up a reputable, credible online banking, an online banking account, you're probably going to earn more than these brick and mortar banks. And the reason why is, think about it, these traditional banks have to pay real estate costs, a tremendous amount of overhead, including employment costs. A lot of these online banks run a lot more lean and mean. And so you can take a lot of that extra income and then flow it to their customers. So you're going to want to make sure your emergency fund is all squared away. 3 to 6 months, depending on your situation. Then preferably, if you can, look into utilizing an online bank. And then you're really squeezing the blood out of the turnip and getting a juicy return on your savings account. So the fourth personal financial goal to achieve by 40, reevaluate what is most important to you financially. You're not supposed to say, I can guarantee in this industry. It's kind of taboo, but between 20 and 40, your goals are going to change a lot. So for one, if you are listening to this podcast, you're most likely a pretty motivated person, which means that some of your goals will be achieved and you will have new ones. So you also might, you might decide to get married, you might decide to have kids, and, God forbid you love your children. You're probably going to want to provide for them in this world. And because of this, you're going to have to reevaluate your money goals and really just goals in life. But again, this is a financial podcast. So what if you're just going along, you're saving for retirement, but then you realize, hey, I want to save up for a down payment on a home. Well, guess what? That free cash flow you have, you may not be able to rev the engine on the retirement plan side of things as much. So you might need to pull back a little and be more immediately prudent with the dollars today and start setting that aside for the down payment on the home, especially if you're trying to save within the next year or 2 or 3 or 4, heck, even 5. I know it sounds really boring, and you're going to probably succumb to the fear of missing out from all of your friends and family. They're investing in the next hot thing, but it doesn't matter, because as long as you're taking that free cash flow and you're setting it aside prudently for that immediate use of the down payment of the home in this case, and you're not taking on any unnecessary risks in that process. So, and that also ties into understanding the basics of time horizons of money, given what you're trying to achieve relative to the unit of risk in which you're taking. So there's a multitude of factors that are going to go into this, and we'll talk about that actually later in the show. But the whole point is you need to reevaluate constantly what are those goals. Because if you're not doing it, these new goals are going to come at you and you're going to get just slapped in the mouth with reality. And then that might actually negatively impact you financially. That's not great. That's not what I want for you. And I know that's not what you want for yourself. So the only other example I can think of before we move on to the next one is, let's say you're saving for college for a kid or post-grad or whatever the case may be. There are a multitude of options out there, but instead of saving for the down payment on a home, for retirement, you may take some of that free cash flow and look into investing in a college account. And as of today, the most popular that we see is the 529 plan. I'm not going to get into the pros and cons and the minutia of what that entails. We've talked about that on previous episodes. And actually, it's kind of interesting. There was a law that was recently passed where if a beneficiary, or I really should say account owner of a 529 plan has held it for 10 years, and let's say you know that maybe college or post-grad, it's just not your kid's thing or whoever owns it, you can actually convert that into a Roth IRA. And that's actually a pretty cool Swiss Army knife that we did not have up until very recently. Now, the fifth personal financial goal you're going to want to achieve by age 40, you're going to want to make sure your will is in order. Now, this is going to be more of an estate planning need than a financial planning need, but it does fall into the concept of money. I mean, let's think about this. You are going to want to make sure that your money is all squared away, because God forbid you get hit by a bus and you enter those pearly gates sooner than you would expect, sooner than you would like, and you haven't gotten that done. Your whatever it is, your spouse, your kids are going to have a nightmare with your money. Now, obviously, at that point, you're not going to care. But I'll actually tell you, I've seen some estates absolutely demolished by not having just a basic will or estate plan in order. And in fact, I can actually think about one. Oh man, this guy never really became a client. 2017, he was supposed to meet with me at the beginning of the year. And one of the things I asked him was, hey, do you have your estates in order? Do you have your beneficiaries in order for your individual retirement accounts? He's like, yeah, I think so, but I'll get back to you on that. I'm like, okay, well, I need that information when we go over the plan. And that day came around, never showed up for the meeting. And, early on in my career, I just absolutely irked me. It still irks me when people miss meetings, but at this point, it's like I've got so much on my plate that I could just pivot and do something else. But I remember thinking to myself, man, why? We had good rapport. It was a fantastic first meeting. And then a week went by, left a message, didn't hear anything. And then a couple days later, I saw in the paper that he passed away in a drunk driving incident. And then a week after that, I get a call from one of his kids. And what ended up happening was he never updated the individual retirement account beneficiary forms, which the beneficiary forms for an individual retirement account or Roth IRA or a 401k, that actually supersedes a will, and it's completely free. So you're going to want to make sure you complete that. But because he never updated things and he never really had anything on record, Washington State is a community property state, and he was recently married a year or two before that. And I guess his new boo was not a great person. She got everything. And I remember the kids asked, what can we do? I mean, you can talk to an attorney and, I'll pray for you, but you're kind of out of luck. And those kids were counting on that money. And it was to the tune of a couple $1 million. It was not insignificant. So have your will in order. And, when you do that, you are going to feel so much better off. And it's not a fun conversation. Now, one piece of advice when my infinitely better half, Stephanie, was not only pregnant, but we were within the 2-minute warning. We actually had our estate plan done. And I highly recommend, especially for you guys out there, if you are married and your better half is a couple weeks away from having your child, do not do the estate planning at that time because the hormones are out of control. It is not a recipe for success. But jokes aside, you're going to want to do it as soon as humanly possible. And if you are in that situation, just make sure you have boxes of tissues on deck. Now, on a lighter, more exciting note, I'm going to take a quick break for today's sponsor of our show. I'm going to get a sip of water. I'm going to come back, and we're going to keep on cranking through the top 10 personal financial goals to achieve by 40. So marketing team, roll the clip.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotu, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. We're going to keep on going. And I promised that we weren't going to be as morbid as the will and estate planning side of things. But this one is important it is admittedly a little bit boring. Number 6, make sure your insurances are all squared away. Insurance is pseudo-depressing because you're buying life insurance for the inevitable if you are no longer here, or disability insurance, you're buying it for if you hurt yourself. And then long-term care is equally as depressing because you're buying that for if, or more likely when, you start to have a couple screws loose as you get up there in age. Now, life insurance is pretty cut and dry. You're going to want to make sure that, heaven forbid, something happens to you, your loved ones are taken care of and they can maintain the standard of living that you guys have today, plus maybe a little bit of an upgrade, okay? Don't have too much of an upgrade because then your better half is going to want to murder you. But you're going to want to make sure that that's all squared away and taken care of. Now, there's 2 types of life insurances out there. There's temporary insurance, which is term. And the way that I use it, or I describe it, as term insurance is for if you die, and then permanent insurance, which is whole life, universal life, variable life. There's blended permanent policies in between all those. Permanent is for when you die. And often it is not an either or, it's an and. And especially if you are listening to this and you are under 40, way under 40, chances are you're extremely motivated. But then the bummer with that is you are going to have some estate tax issues. And that's when permanent insurance could be a viable option. I'm not going to get into the depths of insurance. We've talked about that on a previous episode. But when it comes down to having your life insurances in order, you're going to want to weigh the options of utilizing term insurance. You're also going to want to weigh the options of utilizing permanent insurance and how that fits into your overall portfolio, because it can be extremely beneficial. Disability insurance, mentioned that earlier, pretty cut and dry. Now, this also depends on your job, okay? So for me, I used to use this example. It's probably not the best one, but I could be basically Stephen Hawking and do this job, okay? Probably not the best example in recent times, but for me, do I really need disability insurance? I could argue that. I still have it, but I could argue no. If, let's say, you were a CPA or an attorney where, let's face it, you're doing a lot of paperwork, you're doing a lot of thinking, but it doesn't require a lot of bodily risk. Disability insurance, it's probably not going to be as important. If you're in construction or, on the extreme side, if you're a UFC fighter or in the NFL or whatever the case is, you're going to want to make sure you've got a rock solid disability insurance policy. And then long-term care, it's interesting. A lot of people with long-term care, or when they think of long-term care, they think about it in their 50s is more likely not the earliest people think about it. And then 60s or 70s, because you're, let's face it, you're knocking on heaven's door a little bit closer than those that are younger. And you start to forget things and you remember your parents and the cost of all of that. It's kind of a fascinating thing because if you think about it in your 20s, 30s, or 40s, these insurance companies aren't dumb. They know that you're a whole heck of a lot cheaper than someone closer to the end. And so if you did have some long-term care insurance that you bought today in your early years, by the time you get to that point where you're going to need it, the compounding, most likely, that your long-term care policy could pay for the majority of, and in some cases, all of your long-term care needs. I don't know about you, but right before my grandparents both passed away, it got up to the point where their long-term care on a monthly basis was $10,000. That doesn't include any other expense that they have. Just the long-term care, $10,000. And if they did not have long-term care, they would have been broke years before they passed. Okay. Now the seventh personal finance goal that you're going to want to achieve by 40 is investing in your health. So there's the whole saying of the 4 pillars of a good life are health, wealth, love, and happiness. Now, notice how health is the first one on that list. And, as to why, I mean, heck, if I know, I have my theories. One of my main theories is, as far as being healthy, if you're not healthy, that's the foundation of everything in life. For those of you that know me well, you know that I used to compete in drug-free bodybuilding. Health and fitness has been extremely valuable for me because growing up I didn't have that health. Now I do. And I can tell you right now, by investing in my health, part of it was by accident. I just got into the gym and I just fell in love with it. But the other part, once I realized the value in being healthy, I stuck to it. And that not only has kept me healthy and, knock on wood, I've been in remission of Crohn's for about 11 years now, but I was able to take that mental framework of how do I get healthy, and I was able to pivot that into starting my business, becoming financially successful, and then having an amazing relationship with my wife, becoming a better father, being a great brother. Like, I could go down a list of all the things that health has provided me, but by reinvesting in my health, it's one of those things where you don't necessarily see a dollar for dollar return on your investment, like if you bought a stock or a bond or whatever the case may be. But it's kind of the unwritten rule of, if you're investing in your health, your rate of return on just about everything in your life is going to skyrocket as opposed to you not doing it. And let me also tell you, the sooner you wait to get healthy, the more difficult it will be to get there. So number 8 is actually know what the heck is going on with your personal finances and investments. Now, I'm not saying you got to go down the road that I did and just devote your entire being to capitalizing people's finances. But if you don't have a basic idea of what's going on with your finances, whether it be your overall financial plan, the individual investments, it is going to haunt you. It's going to haunt you a ton. Now, if you're on this personal financial journey solo, without professional help, this is an obvious no-brainer. Like, of course you're going to need to know all this, but you do need a reminder if you don't understand this and you're doing this on your own, to go back and really ask yourself, do I know what is going on with my personal finances, and do I know what is going on with my investments? If you have a financial advisor, but for sure you're going to want a planner. In my personal opinion, if you're talking to someone and they are just a financial advisor, you're going to just want to go somewhere else. Because frankly, they're kind of going extinct. You're going to want a planner, or you're really going to just want to do it on your own. But that's kind of a side note. If you have a professional helping you, now is the time to ask them what is going on with your plan and investments. And there's a couple questions I actually want to give you to ask them. You should be asking, why are you investing in the funds or businesses or piece of real estate or whatever? Why are you investing in them? What is their policy in creating a portfolio for not only you, but for clients in general? What is the philosophies that they have in regards to your plan, in planning in general? And my favorite, ask them what is in their portfolio. When you ask anyone, but for sure someone in our industry, what they are doing with their money, and you ask them what they're worth. I know that can be really taboo. Ask in this business. Why the heck not? I am in the business of doing that. And I have, in fact, last year, it was kind of funny. I was at a high school speaking to the senior class about this. And one kid asked me, what are you worth? And, a bunch of kids were laughing. And then a couple teachers were like, you can't ask that. Of course I told him. Why not? I got nothing to hide. Okay. And if you ask your planner what they're worth, what is in their portfolio, and as well as all these questions, you're going to quickly discover if your trusted money mind is practicing what they're preaching. Now, a couple caveats here. Obviously, if you are in your 60s and your advisor is in their 30s, there's going to be some clear differences. Like for me, I'm 32. Do I need some lifetime income strategy that is designed for people, 55 and older? No, I don't. Do I need within my long-term portfolio, or my overall retirement portfolio, shorter-term investments? No, because I have no immediate short-term needs right now. I don't, okay? So, we're paying for a remodel, but we've saved up for that. So now that we have that set aside, anything above and beyond that, my wife and I are investing for the long term. So clearly there are going to be some discrepancies, but when it comes to long-term strategies, okay, if your planner or team, right, is not doing the same thing that they are telling you to do, you need to find another advisor or planner. The 9th personal finance goal you're going to want to achieve by age 40 is becoming financially independent. Now, this may come as a curveball of a goal, but think about this for a second. What if you had enough money invested where if you wanted to, you could live off those investments' income or dividends alone and not have to work another day in your life? That'd be pretty cool. Here's another scenario. What if you had enough money invested where you could live off of your portfolio for, say, 6 months, a year, 2 years, and take some time to do whatever you wanted to before you look to get back into working? The earlier you start capitalizing your finances, where do you go to make sure that this can happen? And what I mean by that is, where do you go to invest to make this happen? And there are a number of options. There's the stock market, there's real estate, there's private equity, there's lending. You could sprinkle in hedge funds, you could sprinkle in limited partnerships, these long-term investment strategies. The list is actually, it's not infinite, but there's a lot of them. The point, though, is it doesn't matter if you're utilizing just one of those strategies I mentioned, a couple of them, or the full gamut. The point is, you're going to want to make sure that you're utilizing these strategies to the earliest availability possible, because by the time you get to 40, as that compounding continues to go, let's say you keep reinvesting and reinvesting and reinvesting, you get to 40 and say, okay, could I pivot for a little bit? Instead of reinvesting, could I take my dividend income and live off of that for a little bit? Could I take my dividend income plus a little bit of principal and maybe bridge a year or two out so I can just take a break until I get back into the game of working and building my net worth for a second retirement or transition period? Now, the last one, the last personal finance goal to achieve by age 40, know what you need to do financially for the rest of your life. Now, some of you are probably like, yeah, no duh, that sounds freaking fantastic, which it does. But I want you to hear me out because I'm very serious on this one. Ask yourself this for a sec. Would it be valuable to you if you knew from here on out every personal financial money move you need to make for the rest of your life? You know what to do, and you don't even have to second guess it. And better yet, ask yourself this and sprinkle in the fact that you won't have any unnecessary emotion when it comes to what you need to do financially for the rest of your life. It's no different than brushing your teeth. Now, if you get highly emotional when you're brushing your teeth, I seriously suggest you check into a counselor. But brushing your teeth, it's pretty black and white. I mean, your teeth are hopefully white, but you get what I'm saying. It's pretty cut and dry. You brush your teeth and you just move on. What if you had that mentality with money? Forever. No emotion. You just do it. But I bring all of this up because, lucky for you, that is exactly why we are doing this show. This is exactly why I wrote my book. That's exactly why I created my masterclass on this very subject. And if you decide to go that route, fantastic. Okay. Little bias, strongly recommend it. But if you don't and you decide, hey, I want to do this a different route, there are a ton, and I mean a ton, of books, research articles, white papers you are going to need to read to get caught up to speed on all of this. Now, regardless of what route you decide to take, the moral of this last and final financial goal, it's not only a winner to achieve before you're 40, it's a lifelong goal. Never stop learning. One of the traits that I've learned from the greatest investors of all time is, and especially ones that have come on this podcast, is that they have never, ever stopped learning. And I could go down the list. You know, Gautam Baid is the youngest investor and hedge fund manager we've had on. He's in his late 30s. I know he is not going to stop learning for years. You've got Adam Cecil, Guy Spear, Robert Hagstrom in their late 50s, early 60s, mid 60s. And in many ways, they feel like they're just getting started on the learning side of things. And I always find that fascinating because some of these guys are double my age and they feel like they're just turning the corner on the learning side of things and they're hitting these new frontiers. Meanwhile, some of them are worth hundreds of millions and in some cases billions of dollars. So, you know, if these people that are worth multi-millions are still soaking up financial knowledge like a sponge, I'm not saying you've got to be a multi-millionaire someday. Okay? I'd like for you to. I'm not saying you have to be in this industry. I'm not saying you have to be obsessed with what I do. In fact, I encourage you don't, because it's not for everyone. But if you are going to succeed in your personal financial journey, you've got to know that you will never be able to stop learning. So never stop learning. And that does it for today's episode on the 10 personal financial goals to achieve by age 40. And I could have gone down 20 or 30 of these, but I found the best 10. I hope you enjoyed that. If you have any questions about today's episode, if you want to take on more Capitalize Your Finances content, whether it's the book, the course, you want to go back and listen to previous shows, if you want to become a guest on our show, if you are oh so fortunate, hit me and my team up. Go to capitalizepodcast.com. You're going to get all of that information on the website. And we look at our inquiries every single day. And then lastly, if you have a personal financial planning question that you want me to answer on the show, or you just want to shoot me a question, say, hey, I've got this on my mind. Can you help me out? Can you answer? What is your take, Chris? You have every right to shoot me an email, chris@capitalizeyourfinances.com, and I will get back to you as soon as humanly possible. As always, I'm your host, Chris Ray Panayiotou, the Cap and Capitalize. And until next time, keep capitalizing. Take care.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Capitalize Your Finances or from any other investment professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. Earnings from a 529 college savings plan can grow tax deferred and may be withdrawn free of federal taxes when used for qualified education expenses. Non-qualified withdrawals are subject to a 10% penalty tax. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims paying ability of the issuing insurance company and are subject to their terms and conditions. LPL Financial Insurance License Number 0518721. LPL-IA Insurance License Number 0B91442. Christopher Paniotto is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial. David Blanchett and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.